Hi, Emin Xiao here. Thanks, Terence, for answering my question earlier. Um, I understand that my robo advisor is like, I don't know, it's like a latest trend among my friends because like we're all in our early 30s, right?
Okay.
So like what do you think like if we put in just a small amount of money or because okay basically like I believe you all heard of Mr. Lu, right, from 1M65. So he
Mm,
previously mentioned that I think the like Stashaway, for example, they are very good at like building like e-commerce companies. Then within a few years, they'll sell off. So he has no faith lah in Stashaway, like these kind of companies. But I just want to ask your opinion because all my friends are like asking me like, oh, you want to get my referral code and stuff. So I just want to find out more because I'm totally new to investment. I mean, I just
sure.
joined like, the introductory last week.
Okay, no problem. Okay, so number one, you have to understand robo advisor is to replace the physical human advisor. Okay, I know a lot of people maybe didn't realize. So previously, before robo advisor gets so popular, if you actually want to have financial advice, you can actually go to financial advisors. A lot of people thought they are insurance agents. Okay, so like for example, there are some more proper financial advisors, like for example, people from Philip Capital, so on and so forth. So what happened when you actually go to this advisor here is, okay, I got this 100,000, I got this 200,000. Can you tell me what to buy? Then those physical human financial advisor tell you, oh, you got 100,000. Okay, let me understand your risk profile. Oh, you are risk adverse. Then maybe I should recommend you this bond fund, that bond fund, or they actually mix and match funds for you. Okay, so number one, robo advisor is not a product. They actually just replace the human advisory part. Okay, that's one thing about robo advisor. You understand, they are not product. Okay, number two, okay, eventually the human advisor and the robo advisor, end of the day, invest in the same thing, which is most of the time exchange traded funds or just unit trust or just funds. Okay, so eventually, you're just buying a unit trust or just buying funds. Okay, it's just that now you actually have this robo advisor to tell you what fund to buy. Okay, so I think like what Terence said, there's some truth. So you can also see Emin and Jimmy maybe it's some form of advisor. Okay, because end of the day, you're not investing in email, Jimmy. Okay, we also will help you to guide into what funds to buy. Also, number one, understand why robo advisor is not a product. Okay, so number two, personally, I always believe in diversification. Okay, so I think it does make sense to spread your money around. So yes, if let's say for example, a lot of friends interested, you want to try, sure, why not? But of course, start small lah. Start small. So that's how a lot of us started. Also, like for example, I first started, I also put money in stocks, put money in unit trust, put money in property, whatever, put money in REITs, put money everywhere. Okay, then after a while, then you know what suits you better lah. So yes, I think it makes perfect sense to if you like it so much, just try a bit. Okay, so the only thing to watch out for robo advisors, or especially let's say when choosing among the robo advisors, is the fees. So of course they are not going to advise you for free. Okay, so one of the fees, if I understand correctly here, is this, because robo-advisors, they will actually review your portfolio on a regular basis, then they will actually recommend you to swap funds. Okay, they recommend you to swap funds, or they call it rebalancing. So every time you swap funds, mean you will be selling funds, being buying funds, then they actually make money from there. So that is the part you have to be wary of with the fees. So I agree with Terence, like for example, people myself, Terence or Jimmy, we why do we actually need an advisor? Okay, so we know how to choose our own ETF, we know how to choose our own stock. Okay, in that sense, we cut away all the fees, which of course, hopefully after this program, you also can choose yourself donate advisor. So how I answer your question, I mean, feel free to add on if there's anything else. Yeah.
Okay. So to Chow Yi, right? So Chow Yi, I just want to add on very specifically the question that you asked. You are referring to Stashaway. So Stashaway is a robo advisor that obviously they have a fund manager, have a licensed fund manager. They are licensed under MAS as well. They basically have package the portfolio already. In other words, you don't they don't choose. You are not allowed to choose the sectors or the type, the asset class. You can't choose. They actually package it in terms of different risk levels. So if you have a higher risk, they put you into this basket of higher risk. And then if you are lower risk, then you put in the lower risk, and then you put and then you basically, if you are on the lower side of the risk, then you pick the lowest one, and they will actually invest for you automatically. They actually do it through algorithm. All right. In other words, they have pretty complex software, and based on the risk, they basically invest in ETF or unit trust, like what Emin has just mentioned, but they will do auto buy and sell through their softwares. All right. And do it on a daily basis, what we call rebalancing. So in other words, like for example, if the US market is too high, what they do is that they will sell off some of the US shares, and then they will park it on, let's say, for example, last night silver actually dropped, and then they will actually go to silver. And then if the gold price is high, then they will sell gold, and then they will just do this thing perpetually on a daily basis, right? So I'm not going to say whether other people, opinions on certain robo-advisor, whether is it going to be a startup or things like that. I mean, that is his opinion. But my personal point of view is that if you are using it as a tools, you must know what are the tools for, what you want to use, and using a robo-advisor like a stash away, it actually takes off a lot of trouble. Now, for example, like if for people who say that I don't want to learn all this, I just want to put in money and make some money out of it, you can do with stash away, but then again, you must know the risk that you are in. But let's say for people like me, I really know where they are because I spoke to the CFO, not the chief investment, CIO over there. They are very helpful people. They explain a lot of terminology. I understand where they come from, and I actually put some money with them, to be honest with you, because I just want to test out how their system works and if it works well or not. So that's basically how I do it. So I hope I answered your question for that. Thank you.
Thank you, Emin. Thank you, Jimmy.
Yeah.
Thank you. Thanks. Yeah. Okay. Anybody else has any other questions?
Hi. Yeah, I have a small question.
Sure.
Yeah. So so I was looking around at the FSM one. Then I was quite interested in this. Let me see. Nico EM disruptive innovation, the $6 one. Then it's just because the basket of companies are those that I'm interested in lah. So for something like this, right? Is it advisable to like go in because they have option to do RSP or just like outright buy with 1,000 Sing dollar, right? So what would be advisable like that in such a case, because they have two options?
Okay, maybe I'll just see my opinion first, then let's say both gentlemen have anything to add. So personally, for me, unit trusts, it's always good to do RSP. Okay, unit trust or bid funds, it's always good to do RSP. Yeah. Okay, now you have to understand one thing about funds or unit trusts. Okay, they are end of the day, they're basically at the mercy of the market forces, which means if let's say the STI down, or very likely most of the funds will come down, or let's say for example US market down, most of the funds will come down. And if let's say the what you call that, the market go up, right, then most of the funds will actually go up. They are actually highly dependent on the overall market because it's actually structured. So that's why in that sense, it's very hard to find a perfect timing for a particular unit trust. Okay, it's very hard to find a perfect timing for a particular unit trust unless you are very sure that this is the lowest point, or unless you are very sure that this is the highest point, don't buy. Also, the best way for unit trust is actually to, do a RSP, then you even up. Okay, we will actually talk about unit trust lesson. So, in fact, the top, or unit trust or ETF, so in fact, the top disadvantage for unit trust or ETF is that basically the fund manager's objective is not aligned with yours.
Yeah.
Okay, that is
Right.
that is the worst thing I don't like about unit trust. Okay, why is that so? Okay, because end of the day, let's say I am the fund manager for unit trust. Okay, let's say I'm a fund manager for unit trust. If usually unit trust will actually benchmark against certain index. Let's say I benchmark against STI. Okay, so how I'm being measured here is if let's say STI drop by 10%. I drop by 8%. I lose money for you. I drop by 8%. But STI drop by 10%. I am a good fund manager. I'm a good fund manager. Okay, and if let's say STI go up by 10%, and my funds only make 5%, okay, I make money for you, but I'm a lousy manager. That's how the market works. So end of the day, even though let's say for example, I think that market is going to drop, I'm actually still going to invest, because if I'm wrong, market didn't drop, then I become worse off. But if I invest, but I still lose lesser, I'm still better off. Okay,
Okay.
so
Different metric.
so that is how the manager may actually process their information. So that's why in the end a lot of unit trust is all based on the market, like go long market, and hence the best way is actually to do RSP.
Oh, okay.
Okay,
Noted. Thank you very much.
I don't know whether Jimmy you have anything to add.
I agree. No, I will go RSP as well. In fact, stash away is RSP, by the way.
Yeah.
Yeah. Okay.
Okay, but having said that, doesn't mean that unit trust is no good. If let's say like what Jimmy has mentioned, if you really like, I don't want to analyze so much, I want to just depend on fund manager, I think it's good. Okay, I think unit trust ETF is good lah. Of course,
Okay.
if you are willing to do it yourself, then that will be a better option. But then there's a lot more time.
ETF is unit trust, right?
Okay.
Yeah. Sorry. Yeah.
We will cover it in the next lesson.
Yeah. It's okay. No problem. Yeah.
Yeah.
No problem.
Okay, thank you so much.
Yeah. Thanks. Thank you. Okay. I think we have maybe about 3-4 minutes. Any last 1 or 2 questions?
Hi, you mean
Hi.
Weekend here.
Hi.
Hello, Jimmy. Hello,
Hi,
Terence.
Weekend. Hi.
Terence, thanks for sharing your scorecard with us earlier. I'm just thinking of one question, especially on the US side. You see that the value, the what they call the current value versus intrinsic value. You find that the current value is typically higher than the intrinsic value, which was explained by you look at the growth story. Now, taking that into consideration, then when does one, cash out of it? Short of I need the money now. Is there any considerations that we need to have to see this thing is fully priced, time to get out?
Okay, maybe let me answer this question for in a way. So basically, you are saying when to sell, I would say, since it's a growth stock, right? I ever spoke to a few friends before, and then the answer goes this way: if the fundamental have changed for a growth stock. So a growth stock, technically, what you do is you look on its growth. I won't say a story, but you have to monitor its growth in its revenue. So that is the main thing. So if Microsoft keep growing, its share price technically should keep growing, because how it continue to make more money, people will start to talk about it and explain it. All the analysts will start pushing up the share price, and then that will goes into that. Then people will start to hype it out, and then that will go into share price. And then when the next report comes out again, then they need to make more money, and then similar story, it will be a cycle, So share price will keep going up for growth stocks. So definitely the main item for growth stock is you have to understand how it's growing and what is the future, or what track is going to be, right? So on when to sell is when I say fundamental change. So when a company starts saying that we want to be profitable, so when you're no longer growing the company in revenue, but you're going to be profitable, that means you are not going to take in market share, you're going to control operating costs and stuff like that. That means you're no longer looking into the future, you want to be a more stable company, and that's where you stop growing. And when this kind of thing happens, if you are a growth company, you will want the company to keep growing, but when you start doing that, then you have to switch out. At the end of the day, that means the fundamental change, and then you switch out. So that is how I see a growth company. And so yes, the growth story is it will always be there, and you just have to monitor the growth rate of its revenue. Basically, that's the view that I have. And yeah, I hope that answer your question.
Yeah. Okay. Thanks, Terence. Yeah, I think so. Thanks for sharing.
You guys, Jimmy or Amy, you have anything else to add to that point?
Not for me.
Not for me. Not for me. Yeah.
Okay.
Agreed.
Any other questions? We probably have another 4 more minutes to end this segment. Any last questions?
Maybe if
Okay.
no question, I will just
Okay, there is
add
there
on.
is. Oh, sorry.
That's question. Okay.
I think there's
Okay.
one.
Okay.
So,
Yeah, share buyback.
yeah.
Don't go ahead, Terence. Yeah.
How do I view share buyback by companies? Okay, it really depends if it's Singapore or in the US. I think it has to be viewed differently. In Singapore, I rather take dividend than getting share buyback. It's because I'm not charged tax on my dividends. But in US, if I'm tax on my dividend, I rather the company do share buyback. Generally it's good. But in Singapore, share buyback in Singapore's investor, they don't view share buyback as a definite gain. There are companies that are doing share buyback like numerous times, like Stanford Land, if I'm not wrong. I would say it's a bad company, but I generally don't like it. And you just keep buying share back at low prices. It doesn't add value, so the share price doesn't go up. So when the share buyback causes the share price to not go up, that means there's something wrong with that. People are viewing it differently from the company itself. So yeah, that's my view. But generally in US, I would say that's good. In Singapore, I wouldn't look at it that way. I would think that in Singapore, I'd take dividends. Yeah. Sorry, across to Amy.
Okay, so I agree with Terence that generally speaking, share buyback may not affect the stock price, or at least directly. Okay, but I actually did attend some AGM before. So there's actually question on some management about share buyback. So basically, okay, you have to understand end of the day, regardless what company, the money is always limited. There's always use for the money. They always have to ask themselves, hey, this sum of money, where is better use? Okay, so if they have so decided that, okay, this sum of money, I want to use it to share buyback, that means the management really like the company, they believe that the company is good, and they believe that either is it undervalued or there's a good reason to buy back. So if the management actually demonstrate that, I think generally it's actually good for shareholders. But I totally agree with Terence, in terms of direct translation to like stock price increase or the value, okay, it may not be so immediate. Okay, yeah. Jimmy, anything to add? Okay, you wanted to say something, Jimmy? Sorry,
no, it's okay. I mean, that I just want to say that if there's a 3 minutes, but right now if the time is up, that's fine.
No, I think you want to say that. I think maybe.
Okay, so it's just an add-on to what Terence has mentioned about Apple. Now, the Apple Car will not be available until 2025. And basically, just add on what Terence has mentioned earlier. And today I read the news whereby Apple Car is going to partner with Hyundai, where they're going to make the cars. The part that is missing out is that Apple supply chain is still Foxconn, and that is located in Taiwan. And obviously one is going to be in US and the other one is in China. So they will continue to have this, what we call the electronics, the assembly, those type of things. So the supply chain of cars and okay, let's put it this way. Apple has a very strong positions in terms of this supply chain, right? And adding the car portion itself to Apple is actually an additional car making process. It is actually not very complicated for Apple, in my personal opinion. Because they are so strong in it, and because of the of people viewing cars EVs and as a whole, is just basically a mobile phone you put with 4 wheels. That's it. All right. So Apple itself is going to take a big leap over that. Now, whether is it going to be a latecomers compared to Tesla and other big boys, we do not know. As Terence said, it could be they could be so late in the game whereby the market shares has already captured by other manufacturers already. But then again, if you look back Apple history, Apple is not the first one who come up with 3G. Apple is not the first one who come up with 4G. Apple has never been the one who come up with all this fanciful stuff. Android is the one who actually pioneered all this fanciful stuff, and then Apple somehow, modify and become his own proprietary. So the game is unknown. I would say unknown. But then again, if you have faith, in that company who at one point of time the share price is only $1 until today where it is right now, then obviously that's a growth story that you have to watch out.